Tax incentives are deductions, exemptions, or exclusions for money owed in taxes to the government. Tax incentives are offered by the government to help individuals or businesses do certain activities, such as investing in expensive items like buildings, vehicles, machinery, or equipment. In this video, we will check out what are tax incentives. Before starting the video, please subscribe to our channel and click on the bell icon so you can get notified when we upload the next video. Number 8. What are tax incentives? Tax incentives are exclusions, exemptions, or deductions from taxes owed to the government. Businesses receive tax incentives from the government in order to invest back in their businesses, make environmentally sound choices, or to support minorities or disadvantaged business owners. Tax incentives appear in a few forms. According to the University of Central Arkansas, tax exemptions, a business does not have to pay certain taxes. Tax deductions, the amount of tax a business has to pay is reduced. Tax refunds and rebates, these pay back a business part of their taxes after they've already paid the balance. Tax credits, these credits can be accumulated and used as desired, in one tax year or the next. To get a tax incentive, a business has to meet the government's requirements. These can include being part of a specific industry, creating a certain number of jobs, reaching a payroll minimum, investing a certain minimum amount in a project. Tax incentives have different purposes according to what the government wants, i.e., more private investment, more jobs, more research and development. They might specifically target industries they want to foster and see grow, such as information technology, agriculture, or biotechnology. Number 7. Tax incentives for small businesses. The IRS has a number of business tax credits available to small businesses and self-employed individuals. You can also carry forward credits from past years and add them to the total credits allowed in the current tax year. Use Form 3800 to claim your business credits. There are a lot of number of forms owners can use to calculate different parts of the general business credit, like the investment credit and the biodiesel and renewable diesel fuels credit. The electric vehicle credit is claimed separately using Form 8834. Your allowable credit limit depends on whether you claim your business income on your personal tax return, self-proprietorship, partnerships, and some LLCs, or you're a corporation. These limits also depend on the outcome of Form 1040, individuals, or Form 1120. Schedule J, corporations. The following tax credits are specific to small businesses in the U.S. and can prove to be valuable write-offs to reduce your tax burden, according to the Small Business Administration. These credits include Small Employer Health Insurance Premium Credit. Credit 50% of premiums paid for your employees' health coverage. Use Form 8491 for more information. Small employer pension plan startup costs. There has to be at least one participant other than the owner. The credit is half your costs up to $1,000. Use Form 8881 for more information. Increased research activities credit. You can get 20% back of your research-related expenses. Use Form 6765 for more information. Family and medical leave credit. Includes maternity leave. You need to pay at least 50% of the employee's normal wages. The credit covers up to 25% of the paid leave. It applies to the 2018 and 2019 tax years only. Use Form 8994 for more information. Number 6. Why does the government use incentives? The government uses tax incentives in order to help increase economic development. Tax incentives makes it less expensive and more profitable for a business to function. States can use tax incentives to encourage businesses to operate in their state, according to the University of Central Arkansas. In a nutshell, tax incentives decrease the amount of tax businesses have to pay to the government. This helps them decrease the cost of doing business and be more profitable. The government wants this so that businesses create jobs or invest more in their state. Tax incentives are a popular tool by politicians to improve the local economy. Number 5. What do we mean by using tax incentives to support community health and development? Federal, state, and local governments all use tax incentives for various purposes. Many states and communities employ tax incentives simply to attract businesses. That use can have many positive consequences for the public good. Depending on the business, more local jobs, more tax revenue, leading to the possibility of more funding for schools and services, an injection of energy into the community, etc. However, it's directly aimed at purely economic concerns, rather than the building of a healthy community in all its aspects. In this section, we'll focus as well on the use of tax incentives to encourage activities that lead specifically toward the development of a healthy community. The 9 elements of a healthy community as defined by the World Health Organization, WHO, at the 1986 Ottawa Conference are peace, shelter, education, food, income, a stable ecosystem, sustainable resources, social justice, equity. Economic development is certainly a contributor to most of these elements, but it's hardly the only one. Tax incentives can be used to stimulate action in a broad range of categories, such as housing, the environment, health, and employment. We'll discuss the uses of tax incentives in detail later in the section. They can contribute to almost all of the WHO's 9 elements. Although peace has proven difficult to achieve for any length of time over the past several thousand years, tax incentives can be aimed at a variety of results. They can persuade businesses and individuals to take positive action, and they may also, at least occasionally, be used to persuade them to stop doing something harmful. The ways that they can be used are limited only by the creativity of those who devise them. We'll explore some creative uses of tax incentives when we discuss how to employ them. Number 3. Are employee incentives taxable? Yes, some employee incentives are taxable, according to the IRS. Taxable employee incentives include cash benefits like a bonus, gift certificates that can be redeemed for merchandise or exchanged for cash, achievement awards that are cash or equivalent, vacation, meals, lodging, theater or sports tickets, or securities. Non-taxable employee incentives include holiday gifts, occasional snacks, occasional transportation fare, or meal money when working overtime, occasional tickets for entertainment events, group term life insurance for spouse or dependent. Face value can't exceed $2,000, special occasion flowers, books, fruit, etc. Achievement awards, as long as they don't fit on the taxable categories listed above. Number 2. When would you use tax incentives? Since tax incentives can be aimed specifically, there are a great number of possible uses for them. How do you decide when their use is most appropriate? The general answer is that they can be used almost any time, often in combination with regulation and other types of incentives. Sometimes when they come in particularly handy, when you're trying to encourage, limit, or manage growth. Tax incentives can be used to encourage building and development in already built-up areas, and thus to prevent sprawl. They can influence the size of developments, invite the preservation of open space, spur the redevelopment of abandoned sites, or foster the rehabilitation of empty buildings into affordable housing. Whatever your community's comprehensive growth plan, tax incentives can almost always play a role in carrying it forward. When you're revitalizing neighborhoods, communities, or rural areas, here tax incentives might be used to try to attack industry or commerce and local jobs, to develop mixed-income housing, or to bring in or rehabilitate an anchor institution, a theater, a museum, a sports facility, to attract residents and businesses. In a rural area, you might employ tax incentives to create environmentally friendly tourism, bicycle touring, farm stays, etc., to encourage farming, or to attract clean industrial operations. When you're trying to meet community needs, tax incentives are often used to assist in the development of affordable housing, but can also contribute to meeting needs in education, business involvement in school systems, employment, job creation, livability, the creation of pedestrian streets and walkable neighborhoods, health, the development of walking and bike paths, subsidies for businesses, health, insurance plans, and transportation, support for needed routes. When you're trying to prevent or fix environmental problems, green building, using environmentally friendly techniques and materials, the purchase and installation of anti-pollution equipment, the use of alternative energy, energy conservation, environmentally sensitive development, research into environmentally friendly industrial processes. All of these and more can be made more attractive and feasible for businesses and individuals through the offer of a tax incentive. When tax incentives can be part of a coordinated strategy, often a well-thought-out combination of tax and other incentives, careful regulation and enforcement, and participatory planning can yield the best results for a community-building effort. Number 1. Can tax incentives be effective at attracting investment? An economic case can be made for tax incentives. They offer a means for government to reduce the cost of capital for high-risk new industries and for mobile capital while maintaining higher rates for general tax collection and location-specific rents. Professor Zhu Sung Jun argues that for countries with large informal sectors and tax evasion pressures, tax incentives can be a means of enhancing productivity and economic growth by preventing firms from shifting into the informal sector or evasion-prone activities. Investment incentives have contributed to the rapid economic growth of countries such as the Republic of Korea, Malaysia, Mauritius, Ireland, Taiwan, and Singapore. However, if incentives are overgenerous or poorly designed, they can result in giving money away without affecting investment and operating decisions. Even worse, incentives can be captured by politically connected firms and used as a merry-go-round for diverting public funds into political finance. And they can incentivize perverse results, such as stretching out investment over time to extend the tax holiday, such as was reported in the case of Dangote Cement and the pioneer status exemption in Nigeria. Do let us know in the comments what you think about tax incentives. Thanks for watching.